All right. So in FDRM, we are going to continue with the same kind of material that we had in IPM. So these three courses, it's one of the unusual ways in which I teach the finance electives relative to how it's taught in other business schools is that the course material is actually not disjointed. There's no distinct material for IPM and FDRM. It's all a one continuum. So we will, because the basic, the knowledge and skills that you need are very similar across the three subject, sub-domain areas. So you will see the continuity and the connections between all these different sub areas. So you will have to basically remember, which means that conceptually you have to remember, you have to be clear about all these concepts. There is no excuse for forgetting what, now just because we finished IPM, then I can now forget about IPM and start, just looking at the fresh material. There's no such thing. You'll have to remember all the basic stuff you learned in IPM. So we'll continue from there. So if you remember what we were doing, we have a whole bunch of notes which we have to finish. Some of you guys have some of the stuff in board you should have already done as part of IPM, as part of your self-study. I may cover some of these a little bit, just as a recap. But the other notes also you have to do. These are your basic notes, okay? And I will cover some of these in greater detail, like OTC markets, etc. Okay, so so this is what you have to do. And then in particular, because of the three projects that we are doing, we started focusing on, so what we did was we highlighted certain areas in bold from here, from the larger set of notes for Introduction to Global Financial Markets. And then we also looked at the particular decision problems which you have to deal with. And so the problems that you had to deal with in your IPM are the same kind of problems you'll have to deal with in FDRM as well. In addition, because you're going to be doing an options trading project, you will be dealing with some additional problems which come up in options trading, which are unique to options trading. So we will be looking at those problems. But in the first place, we have to finish this material. Now, before we go on to that, we have let's look at your session tracker for this course. Okay. All right. Okay. So the first thing is I sent you guys a link to a YouTube video last night, which is your project submission guidelines. So there's a small change. Initially, we had planned to finish on 16th October, which is a Friday. So 16th October would have been a Friday. We would have finished on Friday. But since the PGDM office has actually brought forward my deadline for submission of the grades by a couple of days from the earlier plan, so I want to bring forward the distinction, the submission date for your project, the ending date for your project by 1 day. I'm going to move it from 16th to 15th. Okay, so 15th October, last trading at the end of New York. And then you should submit the deadline. You should have submitted the drive sharing link to me. The drive share. If you see the video, you'll understand the drive share mechanism and how you have to submit the results. You should have submitted it by this time, 16th October, Indian Standard Time, midnight. So, and then in addition to the material in this video, you will have to also make sure that this is not mentioned in the video. Please make sure your font is Meriwether, size is 14, okay? And so submit it properly in that format. And this 26 September, this you can easily get from here. If you look at, for instance, if you go to this, formats, and you just do it in Google Sheets, it's very easy. You can just choose this one, okay? This is the format. So make sure this is done because I have to correct a lot of these papers, a lot of these submissions, so I need to have, I need to be able to move quickly. Okay, so that's as far as the submission is concerned. Just a little administrative note regarding your project submission. Okay, all right. So right. Okay, so let's continue with the course. Let's continue with where we were. All right. So we were looking at the various decision problems, and where we left you guys here is we were looking at position size as we had also covered the various order types in DP5, and we were looking at position size. And for position sizing, we had looked at some of the particular kinds of position sizing that algebraic formulae that you can use to easily determine to model position size. And so we had looked at 3 different scenarios. So please make sure, guys, I've checked your papers, and many people have still made mistakes, even though it was still an open book exam, and there were still lots of mistakes which people made. And so please make sure you go back and clarify and understand exactly how it is done. It's very simple. It just involves a lot of steps. So you should actually be able to do that. Please make sure you read through this, okay? And understand it clearly in all the 3 scenarios. A lot of people made mistakes in the 3rd and 2nd scenarios, even though it was an open book exam. It's quite stunning, actually, that even then people make mistakes. All right, so make sure you understand this, because I don't think everybody has understood it very well. Okay, so we'll leave that there. So this is taken care of, and there's also the element of pyramiding, which is explained in partly in the notes and partly in one of the videos of the course of IPM itself. So this is taken care of. And we briefly looked at DP5, all right? And we are going to look at DP 6.1. Now in DP5, I just want to make sure we cover one type of order, which you should understand, since it is in your notes. All right, everyone is clear about these orders. These are all conceptual. You must make sure you understand the definitions clearly. Okay, all of these things. I think if I remember right, so limit, these are very basic orders: limit, stop. Then we discuss breakout trading systems, stop limit orders. Okay, so I hope everybody has understood stop limit orders. Okay, let's ask, who should we ask? Let's ask Saloni. Saloni, can you explain what is a stop limit order? What happened? Saloni is sleeping. Okay, let's ask Priya. She's also sleeping. I hope you guys can hear me. Who's there? Let's ask Bhavya.
Hello.
Yes, Bhavya.
Yes, sir. Good morning, sir. So basically, stop order refers to that when we buy or sell a stock at a price.
1 minute. There's some problem with my. Let me just check if there's a problem with my sound. 1 minute. Maybe I can't hear. 1 second. Just. One second, let me just check my sound.
System basically doesn't require a...
Yeah, there seems to be no problem with my audio, but there's a problem with my speaker system. Okay, yes, Vipul?
Yes, sir. Sir, can I give the answer?
Yeah, you want to answer, right? Okay, I'm not able to hear the students very well because my speaker system, my PC volume is very low. Let's do one thing until I fix this thing. Yeah, okay, go ahead, Vipul. What do you want to say?
Uh, Hello, sir, am I audible?
Yeah, I can. Yeah, go ahead. I can hear you. Yeah.
Stop order is an instruction to submit a buy or a sell market order when the user specified stop trigger price is attainable or penetrate. A, a stop order is executed at specific execution price and may execute significantly away from its stop price.
Okay. All right. Okay. Fine. So let's do one thing. I understand what you're saying briefly. Let's do one thing since the audio, I mean I'm not able to hear very clearly. So we'll not do too many of these questions today. I'll just just go and take a basic pulse of people who are present or who are able to respond. So when I asked all these people earlier, because I think the audio was malfunctioning. So Bhavya, I could see she had unmuted herself, okay, but I couldn't hear her because I think my speaker system was not functioning. Okay, never mind. So stop limit orders, I want to just make sure you guys understand a stop limit order is a little bit different from a stop order, a pure stop order, where you have, in the case of a stop limit order, you would have a stop level, you would have two parameters. That's why it says two parameters, okay? So you have a stop level, okay? So you have, so let's take this example. This is an average true range indicator. Just remove this indicator, all right. Okay, so if we have, let's say, right? Okay, let's say that I'm going long BSX and at 41, and I want to put a stop at 37. Okay, so if the market drops below 37, I want to exit my position. But I also want to ensure, remember, if I just placed a simple stop order, what would happen is as the market drops below 37, as soon as the market drops below 37, the system would transmit a market sell order, which would basically not have any limitations. A market sell order means after 37, suppose it trades to 36.95 and my stop order is triggered. And when the system sees that the market is 36.95, it transmits a market sell order to execute my stop at 37. And then when it transmits the market sell order, let's say the next price is 35, okay? Then the system will still sell my position at 35. So my stop at 37 will get triggered and actually executed at 35. So these will be your $2 of slippage in the trade. Now this is what happens with what can happen in a stop order, okay? Because the transmission is that of a market sell order after the trigger is breached. In the case of a stop limit order, what happens when you have a stop limit order is you want to make sure that you don't have very high slippage. Okay, so therefore what you do is you put two additional parameter, you put a limit order, limit parameter also, stop limit price, okay, stop trigger and a stop limit price. So now what I do is in case of instead of a stop order, a pure stop order, I place a stop limit sell order, okay. So in that case, what happens, I put a stop limit sell with a stop trigger at say 36.99 and with a stop limit at say 36.5. Which means now what the system will do is once 36.99 is traded, okay, 37 is broken, 36.99 is traded, the system will immediately transmit a sell order, but not a market sell order. It will send a limit sell order at 36.50, okay, 36.5, that's the limit price I set, the stop limit price. So the system will transmit a limit sell order, which is 36 at 36.50, which means now the system will be looking to sell at 36.50 or better. Okay, it will start to sell at 36.50 or better. So which means basically that it ensures that when my stop is executed, I don't get a price worse than 36.5. Okay, that's what it ensures in the case of a stop limit order. So you need to understand these are basic order types, which if you go to work anywhere in industry, you need to understand these basics. So I've covered already market, stop, and limit orders with you, but now we have to cover a couple of other important orders. stop limit, and market if touched. And if you guys go through this, if you go to the Interactive Brokers link, you will find there are many order types which are listed. Those are for advanced or algorithmic trading. If you want to go in and check, you can explore their website and check that. There are many order types listed on the IB webpage. But those are advanced types. I'm just covering the basic, few basic orders. Okay, so the stop limit orders. Right. So now understand this thing here. Okay, so which is why I said 2 parameters. So here you have to enter. Notice that a stop order has only 1 parameter. If you see stop order, when I've listed number of parameters, only 1, which is the stop trigger price. In the case of a stop limit, there are 2 parameters. Okay, stop trigger and limit stop limit price. Okay, so in this case, what happens? If it goes below 37, the market transmits a limit sell order, which means my order will not be done at a price worse than 36.5, which is my stop limit price. So that's what the system is now transmitting, is limit sell order, and it will ensure that it's sold at 36.5 or better. Now, this is the benefit of this order relative to a stop order. What is the cost, or this is like the pro, and what is the con? The con is that there is no guarantee of execution. Okay, this is the problem. We can move this a little bit here. Maybe just move all of this here. Yeah. So there is no guarantee of execution. What that means is, why do we say that? Because if you have, let's say it goes below 37, it goes to 36.95, it trades at 36.95. Immediately the system will understand that the stop trigger price has been hit. So it will transmit a limit sell order. Now the system is looking to sell at a price better than 36.5. Okay, 36.5 or better. Now the limit sell order is already in the system, but because it's a running market, okay, there is panic in the market, there's heavy selling. So after 36.99, the next price is 34.50. Okay. Then what happens is your limit sell order can't be executed, because the limit sell order requires you the position to be sold at 36.5 or better. And the next price is actually market price is 34.5. So how are you going to sell at 36.5 or better? So the system does not execute your order. So what happens is, if this keeps on going, all right, and this is triggering an ad actually. No, it's always triggering ads. Never mind. So if the system keeps on selling off, okay, so if the market goes there 34.5, 33, keeps on dropping, then there is no way for you to exit. I mean, you'll have to execute a market sell order separately. Your position is still locked in there. You're still holding on to your position and the market is collapsing. So this is the problem here. So there is no guarantee of execution. This is a very dangerous kind of situation, which is why I do not advocate placing stop limit orders. I always suggest that you place stop orders, because, and of course, the way you ensure that there is low slippage, okay, or you can't really ensure it, but generally in probabilistic terms, you can ensure you have some control over it.
Excuse me, sir.
Yes, Nikita, do you have a question?
Yes, sir.
Yeah, what is it?
Sir, so if the market price goes to like 36.9, so will the order get executed on its own, or in that case also it won't get executed?
So are we talking about, you're saying, let's say we have a stop limit order, right? You're talking about a stop limit.
Yes, sir. In this example only, as you mentioned that the system will sell when the price is 36.5 or better. So
Yeah.
if the price goes to, suppose 36.90, so
Yeah.
will the order get executed on its own?
Yeah. So if you have placed a stop limit order with 2 parameters, with a stop trigger level of, so in a stop limit order, you'll have to enter 2 parameters. you'll have to enter the stop trigger level, which in this case I have said is 36.99 because I want to place it just below 37. And then I have also placed a stop limit price of 36.5. Okay, 36.5. So in this case, the scenario you're giving is, let's say the first trade is at 36.99. So the system knows that my stop trigger is activated. So it will immediately transmit a limit sell order at 36.5 into the market. And then you're saying the next price is 36.9. In this case, it will immediately sell it because 36.9 satisfies the rule of 36.5 or better. Okay. So limit price, remember, limit price means 36.5 or better. Does this answer your question?
Yes, sir.
Okay. So this is how it will work. So remember how limit orders work. If you remember how limit orders work, if I give a limit buy order, let's say, now if I give a limit buy order at say 41 here, if I give a limit buy order at 41, and after I transmit my order, the next price is actually 40.2. The system will still buy because limit buy at 41 means buy at 41 or better. So 40.2 is better than 41, so it will still buy. Clear? Yeah. Okay, so this is how limit orders work. So it just works like a limit order. So stop limit is nothing but a stop order plus a limit order. It's the two concepts are being combined. Okay. So this is what it means. So it's just that you have to understand this order, how it works. Conceptually, you have to be clear about it. But it's not something that I recommend because of the risk that I just explained to you, that you might have placed a stop order at 37 and just below, you may have placed a stop limit just below 37. Okay. And with a stop limit at 36.5, but the market is gapping down. So it goes to 36.99. Next price is 34.5. Next price is 32. Next price is 30. Then 27, 28. You're still stuck. Your position has not been sold. So therefore, I don't recommend this kind of order, but you should know how it works. You should know the concept. Okay, so that's why it says guarantee of execution, no. Guarantee of minimum price at which min-max price at which execution occurs. Okay, yes. If there is execution, then it will happen at a guaranteed price of, in this case, 34.5 or better. Okay. So next is the other type of order we have to understand before we move out of DP5. The 5 basic order types is this order, market if touched. You can read the hyperlinks to IB. You can read them later. Market if touched is interesting type of order. So these are all different orders which are placed based on your market views. Also try to understand one thing, that just like we have connected the order types, okay, to you can also have another name for this. Yeah, I haven't got the full name of decision problem here, but this is basically what we have done here. Is one of the things we have done in this note is we have connected the common order types, okay, to the decision problems, which is something you'll not see in any other place, in any other textbook or anywhere. You will have some discussion of order types, but you will not see them being connected to decision problems, which we have done in this note. Okay, and the other thing we have done in this note is, what was I trying to explain here? Market if touched order. Yeah, the other thing that you should understand from this is that we have also done this in our discussion, is there are 2 things happening in this note. One is that we're discussing 5 basic order types, and we're connecting them to decision problems, and we are also explaining clearly that order types are very intimately connected to market views. So we can actually write this here. You should understand these 2 ideas. The way to think about this particular note, let me just put it here. 2 things to note here. Order types connected to DPs. All right. You all know DPs by now. That is 1. Order types are connected to DPs. And second is order types connected to here is not very pretty language, but let's change the language a little bit in this case. Related to yes, Mitali, you have a question?
No.
Okay, okay, never mind. Okay, let's all right. So let's look at this. So order types. So two important points to note about these notes when you're discussing these order types. You have to understand conceptually the order types, how exactly they work. Because there are very specific definitions. And then we are also connecting the order types to decision problems. Okay. And we are also connecting order types, we are relating them to market views, which means that every type of order, whether you're going to use a market order, limit order, or stop order, or any of the other types of orders, these are all connected to the kind of market view that you have. And market views, you will notice from these orders, market views can be very sophisticated. You can have all kinds of very sophisticated market views. You can think that this will go down here and then it'll go up. Okay, so in this case, if I feel that this will come down to maybe if I look at 60 minutes, I've already had 60 minutes. So if I'm looking to buy, okay, I can form all kinds of sophisticated views. I can say that instead of, I don't want to buy it at 41 because my view is that this is going to come down to 39. It'll come to 39, but it will not go below 37. So therefore, what I will do is instead of placing a market order, and I'm very confident I already have my market view, I don't need to get any confirmation like a Donchian breakout system rule. So I'm very confident this is going up, but I feel on the short term, I feel that it's going to come down to 39, but it will not go below 37. Okay. So therefore, in this case, I place a limit order. So what you should notice when you're learning about order types is two things, that order types are connected to DPs. And the second thing is also that what type of order you use is very much a function of the kind of market view that you have. All right. So understand also the connection between very sophisticated and complex market views, which are connected to different types of orders. This is something else you should understand. Now, one more thing I would say is that in some of your textbooks, like one that you would have received for FDRM, the Hull book, and some of the other textbooks, these typical finance textbooks, there may be some definitions of order types which conflict with what you find in the definitions I've given you, and which are matching with the definitions on the IB web page. So in these cases of conflict, I would strongly suggest that you go with the definitions on the IB web page because they are the correct definitions. In the case of finance textbooks, they are written by academics who they have never traded in their life. So they may not have a very good understanding of certain types of orders. So any conflict, you go with the IB definition of orders, okay? So that because I've seen certain cases when there are some slight differences in order definition, order type definition. So go with the IB definitions, which I have followed, and I have also used the same. I've just highlighted certain other parts of it. Okay. So understand that they're all connected to market views. Now coming to this, so if you connect order types to market views, again, we just covered stop limit orders. The reason you would use a stop limit order is, let's say, why would you use a stop limit order? In this case, if you went long, let's assume for simplicity, you go long at market and you put a stop limit order at 36.99 stop trigger and a stop limit at 36.5. Okay. Why do you do that? As I said, highly dangerous type of order. I do not recommend these to be used, but try to understand the market view here. The reason the trader is doing is his view is that even if 36.99 breaks, okay, so even if 36.99 breaks, this 37 breaks, there is unlikely to be a dramatic sell-off, like next price is 35, next price is 32, next price is 27. This kind of dramatic, gap selling, okay, a gap, downside breakout with gaps. This kind of dramatic selling is not likely to happen. That's why they feel that if it breaks below 37, fine, there will be a decline, but there will be a gentle, orderly decline, and the market will be trading quite actively throughout. and prices will not move dramatically. That's why they place a limit sell order. Okay, so that is the thinking behind this. So every type of order is connected to a market view. So that's what you have to understand. And but again, as I said, because you don't actually know what will happen, and as I've explained to you earlier. Yes, Sachin, what is your question?
Sir, don't we only set a stop loss just like we done in last session?
You're asking, don't we only place stop?
Stop loss, only stop loss. Then
Yeah.
no.
First of all, don't use stop loss as a term. Use stop. Okay. Because
Yes,
technical term is stop order. So we will talk in terms of the technical.
stop order. Yes, stop order. Sorry.
So you're asking that should we not place only stop orders? Is that
Yes,
what
sir.
you're
Yes.
asking? Instead
Yes,
of,
sir.
are you asking that?
Yes, sir. Yes, sir.
Not
Why
place
we don't place stop order?
Yeah.
Yes, sir. Yes, sir.
Yeah. Yeah. In fact, that in terms of my advice to you, that's what I'm saying. Effectively, what you're saying is, yeah, I confirm.
Because sir, we
You is that you do not place anything. You only use stop orders. Don't ever use stop limit orders.
yes, sir.
Okay. So, but you still have to understand stop limit orders, the concept, because somebody might want to discuss it. So you should understand the concept. But in terms of what you actually do in the real world, my recommendation is only to use stop orders. And the way you control for slippage in the case of stop orders, the way you control for slippage is you make sure you trade only in liquid markets. If you remember this screener that I used at the top, I don't have the screener anymore here, but the screener that I used at the top, if you remember, one of the limits, here, the stock screener, this is just the plain screener, maybe it's the actual screen which we used. So remember, one of the reasons people use stop limit orders is they're afraid that if there is dramatic selling after the break of this support level, then they may get their stock may be executed at a much lower price, like 32.50. But at least it gets you out of the market. All right. So this is what people are afraid of. That's why they use stop limits. But this is a highly dangerous approach because you don't know how markets will actually move. And the way you control for dramatic slippage in the execution of stop orders is by making sure, if you look at my stock screen, the stocks that I gave you, I controlled for the stock liquidity. I adjusted for liquidity by looking at market cap, large cap, and also by looking at average volume. All right, so it's over 2 million. Okay, I would have used over 5 million, but there was no such screen, I think, on this screener. So because we are using the free version of the screener. So that's what I use. So this is how you control for slippage. Okay, you trade only in liquid markets. So so let me just put this once again here as a. Okay. As a big no-no, and now you understand why. Okay, now let's understand one more last type of order, which is market if touched. Now, what is a market if touched? Let's look at another situation where I think maybe the right way to look at market if touched is to look at the oil market. I think it's the best example that we have. Right, okay. Now let's say I'm an oil trader. You can see here what's happening, okay? This is the, if you looked at the daily chart, this is the dramatic selling in the around the pandemic, where we had this dramatic selling. And there was also some negative news from Saudi, and there was some conflict between them and the Russians. That's when the price dropped, and the futures actually traded to negative. The front month futures were trading at negative, and the price went to near zero. All right. Now, what happens here? Let's say I'm a trader in oil. All right. And let's say the market is trading around here at say 27 or something. The market is trading around 27. And I feel that, or let's say the time is around here. It's around 25. And my feeling is that I would like to buy oil, But my feeling is that this market has a chance of, because of the situation with the pandemic and the conflict between the Saudis and the Russians, and they're all threatening each other with, pumping too much oil. And so there's a high risk of dramatic supply increases. All right. So I feel the market still is quite weak. And although I would want to buy it, I feel the market has a chance of selling off in a panic to around $10. Okay. It can sell off in a panic to about $10. And in fact, we can make this a little better, maybe 60. And 60, we can't see the panic setting. Yeah, now we can see the panic setting. Okay. So we can actually, I feel that the market will sell off in a panic to about $10. All right. But right now we are around 25. So what I do in this case, but I'm not, what I feel is that psychologically the market regards $10 as an important support. Okay. And so after it hits $10, I'm not so confident that, I think that the market will just trade at $10 as a psychological figure, because the market likes to hit these round numbers. But after hitting $10, it's likely to come back quite sharply. Okay. So it may not stay at $10 for very long. Okay. So what happens is there are two options. I can follow the simple option, which is if I'm now at 25, I feel the market will go to $10. I can place a limit buy order at $10. Okay. Because I think the market is going to $10. So ordinarily what we would do is we place a limit buy order at $10. Okay. Now the problem with that is that if now you see what I mean by market views, how orders are connected to market views. Now you understand what I mean by that. If I feel that this is see how complex and detailed the market view is. My feeling is the market is in a slightly, nervous state, and it may panic sell. There will be panic selling down to $10, but $10 is just going to hit there and then immediately come back. So now, if that's my market view, if I place a limit buy order at $10, well, the market may trade once at $10, okay, but my order may not be number one in the queue. There may not be enough volume executed at $10, and then the next price might be $12, okay, or $11. So if I place a limit buy order at $10, it may not get executed. So therefore, what I do is I place a market if touched. Now, what is the market if touched order? So MIT order. All right. So we will briefly refer to it as MIT. MIT. We call it a MIT order. Okay. All right. So what I will do now is, because of this particular sophisticated and detailed market view that I have, I will place a MIT order. What does that mean? A MIT order, you notice, also has only one parameter. Okay. So in this case, what I do is I place a MIT order with a $10, trigger. Okay. The if touched price. So this MIT, market if touched, it has two parts to it. Market, semicolon, if touched. Okay. You can think of it this way. If touched. So if this part comes later, actually, the market plus part comes later. If touched comes earlier. So this, I place a MIT order with a trigger at $10, okay? Because I think the market will sell off in a panic to $10 and then immediately bounce back. So what happens is the if touched level is $10 because my parameter, my trigger is entered as $10. And as soon as the market trades at $10, my MIT order is triggered. Now what the system does is, because it's a MIT buy order, the system will immediately transmit a market buy order into the market, essentially. Okay, a market buy order. So the advantage of the market buy order is, if my forecast is correct, that the market will sell off to $10, okay, and immediately bounce back from there. So therefore, I didn't want to place a limit buy order at $10 because I was not sure that there would be enough volume at $10 to execute my order. May not have been. So I place a MIT buy order at $10. So as soon as the market hits $10, the system transmits a market buy order. So what happens is, I'm right now sitting at 25. Okay. my view actually turns out to be correct, that the market sells off in a panic like this and then immediately bounces up. Okay. So I don't want to be particular about nitpicking, about bargaining, about buying at $10, not buying at $11. Once my market view is fulfilled, that the market has sold off and hit $10, after that, I just want to quickly go long, because my view is after this, the market is going to bounce. So therefore, what I do is I place a mid buy order. So the way it works is the system notices that the mid trigger level is traded $10. It immediately transmits a market buy order. So what happens is, suppose the price action hits $10, next price is $11. Immediately my order is executed at $11, because it's a market buy order that is now in the system. Okay, because my trigger is hit. So that helps me, because if I had placed a limit buy order at 10 and initially did not execute because I was not first in the queue, then in the case, if I had placed only a limit buy order, I would have been there left. After this, the market rises all the way up to here, 45 and all that, and I still don't have my long position because I had placed a condition that only buy at $10 or better. But by placing a mid buy order, first price is $10, a trigger happens, then the next price is $11 because it's a market buy order, it buys at 11. So I still get long, my view is correct. And if my view turns out to be correct, I would like to quickly go long at market, because now I think the market's going to rise. Okay, so this is how a mid order works. All right, I hope everybody's clear about this. Okay, all right. Yeah. Okay. So this is what. So we are just trying to make sure that we cover some of the important orders, which are there in your notes. These decision problems are very important. So now, what you have to understand, something else you have to understand here. Okay. So understand how mid order works. So you can see how it is very intimately connected to the highly sophisticated and detailed market views. And this is what happens when you trade technically, especially. You actually end up forming very detailed and complicated market views, and then you place the orders based on your market views. You choose the order type based on the market view. Now, one thing you have to understand in terms of difference between stop and market MIT orders, stop orders and MIT orders. So what is the difference? In the case of a stop order, okay, you'll see this. This is also explained in the IB note, so I'm not writing it here. Yeah, I think I've explained it here just briefly as an example. So what happens? Let's look at a stop buy order and a MIT buy order. Okay. So if you, in the case of a stop, if the current market is 72.76, okay, we're talking about buy stop and buy MIT, buy orders. We're talking about buy orders for the sake of the example. Okay. So stop. Notice this, the market currently is at 72.76. Okay, the market is at 72.76, and the stop trigger will be at 74.85. So notice that it is above the market. Okay, because it's a buy stop. So remember what a stop is. It's very easy to remember once you understand the definition of a stop order. Stop order means it will transact, or it will execute the transaction at a price which is higher than the current, not higher, but less favorable than the current market. And we are talking about buy orders here. So higher than the current market is less favorable. So the stop trigger will be at stop order, the trigger will be at 74.85, higher than the current market. Now, in the case of an MIT trigger, okay, MIT order, the trigger will be below the current market, which is the example that I gave you in this spoil example. Okay? So here you see the difference between a stop order and an MIT order is that when, let's say, the price was 25. Okay? Now I could have placed a two-sided order, that if my feeling is that if it doesn't go below, let's say I'm sitting around here, okay, somewhere here. Now I have a view that the market will sharply sell off and then immediately sharply bounce back. But my second backup view, a contingency plan, is that in case that doesn't happen, then the market will immediately, will directly start rising from here and the warning for that is if it goes above $30. Okay, so I can buy this in two ways actually. I can leave a two-sided order to make sure that I get my execution. I can leave a MIT order, okay, with the example that I gave you. Notice that the MIT trigger is below the market. So the current market is, let's say, 25, okay? 25 is the current market. And my view is that ideally it should collapse to $10 and then sharply rise. Or if that doesn't happen, if it starts to directly go above $30, then the market is starting to go up and I better buy it right away. So I will place two types of orders. First, I'll place a MIT buy order with a trigger of $10. Okay, so if the market trades to $10, this system will immediately transmit a market buy order, and it will get me long at some quick price below the just around $10 hopefully. Okay, but I'm not going to be setting limitations on what that price should be. Just a market buy order. That's one. Now notice that the MIT trigger price is below the current market. The current market is 25. The MIT trigger price is $10. Both are buy orders. Okay. The MIT trigger price is $10. But if I also place a stop buy order or a buy stop order to ensure that if the price goes above $30 and if this dramatic drop does not happen and it directly goes above $30, then even then I want to go long because I think now the market is going a lot higher. So I also place a buy stop order at $30, say $30.01, okay, 30.01. I place a buy stop at 30.01. Now notice that because the current market is 25, okay, so I'm placing two orders at the same time, one to cover the backup plan, okay, and one to cover the main plan. The MIT order is connected to the main plan, okay, by preferred scenario, and the stop buy order is connected to the contingency plan, that if this does not happen, then if it goes above 35, I want to buy. Now notice that the MIT trigger is below the current market and the stop trigger is above the current market. It's $30, 30.01, and the current market is 25. Okay, this is the main difference between a stop order and an MIT order, because actually if you see, as I explained to you earlier, a stop order is like a conditional market order. A stop order is a conditional. You can write this way, you can think of it this way. Difference between stop and MIT orders. Now, why do we talk about differences? Because usually we talk about, this is too small. Usually we talk about differences because both are conditional So if you remember, I explained that a stop order is like a conditional market order because the market looks for a stop trigger, in this case $30. And if the $30 stop trigger is activated, then the system will transmit so the system looks for a condition. And if this condition is satisfied, then it will transmit a market buy order. So it's a conditional buy order. Okay, both are conditional market orders. It will transmit a market buy order when it executes a stop. And MIT also is a conditional buy order. It waits for the condition that is hitting $10, waits for the condition to be satisfied. Once it is satisfied, it will immediately transmit a market buy order. So both are conditional market buy orders, both are conditional market orders, because I'm giving you the example with respect to buy, but it can be sell also. You can replace this with sell. So both are conditional market orders, but what is the difference? In the case of this you can see I'm not writing it because it's there in your IB note, okay? That as we explained in the system as well, that in the case of the stop order, the market price, if you take the example of buy, okay, and if you flip it around, you can flip it around for selling, okay, that either way you can say, you can put it in more general terms. In the case of the stop order, which is consistent with the definition of stop order, the trigger price is less favorable than the current market. Here we talk about buy. buying at a higher price is less favorable. And in the case of the mid order, the trigger price is more favorable than the current market, okay, which you already saw in this case. We are placing two orders simultaneously, and the mid order, the trigger is below the current market, which is more favorable because we are talking about buy orders. And the stop price is less favorable because we are talking about buy orders. So it's 30 is higher than 25, less favorable for buying. Okay, so this is the main difference between stop orders and MIT orders. And here you can also learn about something else, which is a feature that is there which is a property of bracket orders also. You can learn about bracket orders. I'm not going to spend time on it right now because we need to go into other areas. OCA orders. You can also read about OCA orders. This is an important feature to understand. These are some of the benefits that you get with a high-tech system like in IBTWS. One cancels all. Here's an example of when you can use, there are many examples for using OCA, but I can use OCA here as well. OCA means one cancels all means this is like a tag. You understand what tags are? When you post videos to YouTube, you can put a tag like pizza or something like that. And so, anybody who's interested in pizza will get that video as a suggestion. So tag is basically just a way of linking different ideas. So here you have, this is like a tag. Okay, you have an OCA group. You have an OCA group, I can call it A1 or something like that. So what would happen is OCA means one cancels all, which means that if any one of the orders in the group is executed, all the others are cancelled. Okay, so one way of using OCA orders is here. When the market is here 25, I simultaneously place two buy orders. One MIT buy order at $10 and one stop buy order at $30, 30.01. Both orders are in the market. Now what happens? If my MIT order is executed, I don't want this order also to be executed. Okay, this was just a backup plan, the stop order. In case this did not happen, I wanted this. So also in case my stop order is executed, I don't want this MIT order to be in the system because that means my scenario has not worked out. So what I want is only one of these two orders should be executed. So what I do is I put an OCA group. You can experiment with this in your TWS if you have a similar situation. So what I link both of these orders by putting an OCA label. Both are part of A1. OCA group is A1. You can call it whatever you want, B2, A1, C5, whatever you want to call it. So I give the name A1. So my group label is A1. So all orders which have been tagged with the label A1, the system is going to watch them. So if any of those orders is executed, all the others will be cancelled. It's a very useful feature. Once again, you can see here how highly sophisticated order placement technology or algorithms can be used to take care of very complex and detailed market views. Okay, these really come into play when you do technical trading because you form very complex and detailed views on the market. So once again, you can see here in the same example, we are discussing a couple of things. We are discussing the difference between the market if touched and the stop mid and the stop order. We are also discussing OCA, okay, which is given there. OCA means it's a way of tagging. You have an OCA group, one cancels all. So any order in that group, if any order is executed, the system will cancel all the other orders in that group. So as soon as the MIT at 10 is executed, the system will automatically cancel my stop order. So if I, let's say 10, the trigger is hit, my next price is 11, I go long at 11 through the market buy order. And then as the market is rising, I don't want another order to be executed here. So that will not be executed. But as soon as this is executed, this is canceled. Okay, a very useful feature. One cancels all. So you will see that I think many of the Indian brokers will not be offering many of these types of sophisticated orders. And this is another reason why I always say that you do not, finance is a subject you should not be learning with respect to the Indian market because the Indian market is over-regulated, it's very backward. And so you have to learn finance with a focus on US financial markets, because otherwise your learning is going to be incomplete. Okay, if you learn it with respect to the US markets, you can always trade in the Indian markets, but the reverse is not true. So finance always has to be with the focus on US markets. All right, GTC orders you already know. Okay, I would always recommend placing GTC orders unless you have some specific reason for placing other types of orders, such as day order, which will be cancelled at the end of the day. FOK means fill or kill, which means that immediately fill the order. Otherwise, you kill it. Okay, I don't want it to be hanging around. So this is another type of order, but I generally recommend GTC orders because something might happen. You may think like what happened to me this morning. My mic system or one of the something, maybe my USB extension somewhere is not working. So the system's giving problems. So if I'm not able to get in and log into my system, at least my order is already on a GTC basis. So the system is still watching it, although I can't log into my computer. So GTC orders are always better. And that's why I also recommend every position that you have, okay, under stop orders. You already have stop orders, okay, that I've already explained to you, that stop should be always placed in the market, okay. So if I have a position, any time of position that I have, okay, if we look at any kind of position here, if we look at our stops, we will be now trading different. In this project, we'll be trading other kinds of stocks, okay. We will be trading maybe your favorite stock, Facebook. We'll be trading that, okay. So we'll be trading, because we'll be trading options. All right. So if I buy Facebook now at 280 and I want to put a stop at 240, I should not, I should place the stop in the market on a GTC basis. That means in my TWS, I should place it because I don't know what will happen. Maybe there's an earthquake tomorrow in my town. My whole, the system doesn't work. The internet doesn't work. I can't log in. So the protective stop order, if I buy, say 1,000 shares at 280, I want to put a stop at 240. Then the stop should already, as soon as I enter the position, the stop should already be in the market and be watched as a GTC order. So that whatever happens to you, maybe you can't log into the system for 7 days. This order is still in the market. So if something happens to Facebook and it collapses, you will get stopped out at 240, and your stop will be, your losses will be limited. It's very important risk management tool. So certain things to understand, very important order points like what Sachin was clarifying. Always use only stop orders. Do not use stop limit orders. Number one. Number two, these are all risk management principles. Then the number two is stop should always be in the market on a GTC basis. Always place the order in the market. Don't think that I'm going to watch the market and then when it goes below 240, then I'll execute. No, don't do that. Okay, very risky behavior. So risk management is the heart of this business. Okay, if you can manage your risk very tightly, the market can't do anything to you. But if you take your foot off the pedal when it comes to risk management, it's very dangerous. Many people don't survive in this business. They blow out after a few years. And the reason they blow out is for very simple. It's always one problem. They have poor risk management. Okay, so risk management is the heart of this business. Okay, so we have spent a bit, I lost a bit of time, around 10, 12 minutes in the morning. So, okay, so we have covered all this, all the stuff we have covered. You can just read up on the rest of the bracket orders. You can just figure out what it is. Bracket is basically just when you have a position and then you can place, you take a position, okay? Let's say I buy Facebook at 280 and then I want to place a stop at 240 and I want to place a take profit at maybe say 400. So in a bracket order, basically what I do is I just set up, as soon as you enter bracket order, the system will know that one is a take profit, one is a stop. So the system will automatically set up those orders and you have to just change the market price levels. So once I buy it at 280, I can then set bracket orders, or you can even set them with a targeted entry price at 275, and then you can set bracket orders on that as well. So you can experiment with this with TWS. So bracket orders are automatically treated as as a OCA, as part of one OCA group. So if you place bracket orders, and you place a take profit, you buy at 280, you have a take profit at 400, and you have a stop at 240. So if your stop is executed, then the system will automatically cancel your take profit order, okay? Because it is treated as, it knows that this was placed as a bracket order. So therefore, if one goes, then the others are canceled. The other one is canceled. The other side of a bracket. Bracket means essentially two sides. Yes, Sachin?
Sir, in interactive broker, there is a two option, MKT and LK.
What is the second one? MKT and? What is the second option? MKT and?
And LMT.
Yeah, MKT is a market order. LMT is a limit order. And if I'm not mistaken, if you look carefully, you will see under the limit, there will be a small down arrow option for for greater number of options, for greater or for more order types. There should be ordinarily
Yes, sir. Yes, sir.
and then you can highlight that and see more order types, because it should show you all the order types. It should show you stop limit, MIT, everything. Check it. Okay. Yes, Sachin?
Yes, sir. Yes, sir. There is all options. Yes, sir. Yes, sir.
Yeah. So my MKT is for market, LMT is for limit, and there should be orders for, I think, STP for stop. Okay.
Yes, sir.
Yeah, and so on and so forth. All the order types are there. You have to just click the drop down menu.
Yes, sir. Yes, sir.
All right. So I think that completes our discussion of order types. Okay. GTC and this, we've already covered all this. Yeah. Now there is a note on this. You can read this a little bit and try to understand this technology architecture of trading. This is, you can read this on your own and understand it. And if you have questions, you can ask me. Okay. That basically this, we don't need to spend too much time on this, but try to understand, develop a sense of how the technology architecture works, what are APIs, how the system works, how it connects to the basic idea here is that there are three kind of main entities. When you have the customer trading system, which is say Sachin sitting in his room and trading, and then you have the broker software. Okay, so he's at one end, he's generating some trades. And you have the broker software, and then you have the exchange software also. So the broker IB is not an exchange. And when we cover exchange traded markets, you'll understand this. Then you have the exchange itself. The exchange itself has the software. Like for instance, NASDAQ you heard of. NASDAQ is just a bank of computers. Okay. So when Sachin places an order on the NASDAQ, he's generating an order. It goes through the broker system. He may have set up an API on his own, okay, that you can read about on your own. That's also a piece of software that he may have some trading rules, and then he generates some trades and or orders, and then it goes to the broker software. From there, it goes to the exchange. Okay, CME GlobeX, or here I can write NASDAQ. If you go to the NASDAQ market site in New York, you will see that, of course, they just have fancy ticker tape displays and all that, ticker displays and all that. But it's just a bank of computers. There is no exchange as such. There's no exchange floor. It's a bank of computers. So then the system with the broker IB transmits it into the NASDAQ server, okay? And then the system is there with the other orders, and it interacts with other orders. And that's how the trading execution happens, okay? But everything is happening at very high speed. And so that's why you have all these terms like high frequency trading and all that, because now you have, because of the growth of technology, right? So you can see all this, we can have these, you can read this a little bit on your own, try to understand how the system is working, okay? What are algorithms and things like that. So, so this would be OANDA is just an OTC market broker. So you have not covered OTC markets and exchange traded markets. We'll cover that later. Again, ETM is for exchange traded markets and OTCM is for OTC markets. You can cover it in your notes. I would suggest you read it on your own. We have some to get an understanding. You can read the notes on your own, try to understand it. Okay, and we will try to cover it a little bit. We will still have to get our get into our project. So we may not have enough time to cover it immediately. So you can read about it a little bit. Okay, that's one. Now the other thing I want to make sure we see here is that there's this concept of, since we are talking about order types, I think we should cover this concept quickly. Okay. Now, if you see, you will see in your trader, there's this concept of market depth and the order book. Order book is nothing but basically, if you look at this, that's why you have to understand the technology architecture of trading. If you look at, now suppose Sachin transmits a buy order for Facebook at say 270. Okay, so Sachin transmits a 270 buy order at for Facebook, say let's say for 5,000 shares. And then a little later, Vipul transmits a sell order at 290 for maybe 10,000 shares. Okay, so we had some of these. We anticipated some of this when we discussed about spoofing. Okay, so here what happens is, now when all these orders are going to go and sit in the NASDAQ order book. Vipul's order to sell at 290, Sachin's order to buy at 270. These are all sitting in the NASDAQ order book. If you look at the full NASDAQ order book, you can see all these. Let's say Vipul's order is for 10,000 shares. So you can see all these. You can see that you won't see Vipul's name or Sachin's name in it, but you will see that there is an order for 10,000 to be sold at 290 when the market is at 280. Then you'll see that there's an order to buy 5,000 shares at 270. Yeah, all this stuff is there. This is all sitting in the NASDAQ order book. Okay, in the exchange server, in the order book. It's yes, Vipul.
Sir, suppose my name was not written there, but sir, there will be a unique ID which will differ me from other. Will there be a unique ID like which will be allotted when the Demat account is open?
Yeah. So what happens is, the way it works is that the information is, see, there are three parties involved here. There is a customer, there is a broker, and then there is an exchange. Okay, so let's look at this here. Okay, here, this is, let's say we give an example of NASDAQ, we can just keep it there. So there is a broker, and then we should really call it the exchange here. Let's just highlight the exchange. Okay, let's to highlight the parties. Let's
like sir, in India, sir, NSDL and CDSL were there, sir, and
yeah,
all the stocks were stored in that.
Yeah, I'm just answering your question. 1 minute. So the way it works is that the NASDAQ server will only see your order of 9,000 of 10,000 sell 10,000 at 290. Okay, and it will only see that your order has come through, and that is not even shown in the order book, that information on the broker. The only thing you'll see in the order book is actually the information about, let me see if I can get this up on a IBTWS order. Because I'm trying to avoid having to log into IBTWS. But anyway, so what will happen is the system will only see that there is an order to sell 10,000 shares at 290. Okay, it will not see Vipul Garg's name in it. Who knows about Vipul Garg? It's your broker. So the system only sees that this order has come through Interactive Brokers, and that's also not going to be shown in the order book. The order book will only show sell order of 10,000. Okay, you can actually check your order. I don't want to log into TWS right now, but if you log in, and you will see, if you go to I think under trading tools, you can experiment with just to right click on any of the tickers, and you will have some experimental foreign exchange tickers. You can right click on those as well. If you see, I'm just trying to let me just see if there is book trader. Yeah, there is an option called book trader. Let's have a look at this book trader. Okay, let's look at this book trader here. Let me see just, so basically the order book which is there on the system, okay, it will only have, yeah, okay, let me just take care of this now here.
Just by clicking in the field, you can
I'm
enter
just
new
going to pull
underlying
this,
contract.
I'm just going to pull this here, okay. Now you see here, if you see this, essentially this is what it is. Of course, it's not really blown up a lot, okay? But there is something called Book Trader. If you right click on your system, you can get to Book Trader. You can watch this video also. I think this is by Interactive Brokers. Yeah, Interactive Brokers, Book Trader. Okay, here you can see what is happening. It will only show this. It will only show how many shares, okay, or how many units and what price. Okay, that's all you see, and this is the market price essentially. Okay, so it shows all the buy orders and all the sell orders. So it shows this is the market price, and it shows you at what price and how many shares. Okay, how many units, and that's all you see in the order book. Okay, and you don't see. Who knows about Vipul Garg? The NASDAQ system will keep a separate log that these orders have come from. This sell order has come from through Interactive Brokers. Then Interactive Brokers knows that among its many customers, this particular order has been placed by Vipul Garg. That information is with Interactive Brokers. It is not normally with the exchange. They don't really require it because whatever happens in your trades, they will catch hold of Interactive Brokers. So that's how it works. Okay. Does that answer your question, Vipul?
Yes, sir.
Okay. All right. So now let's just understand something called order books and market depth here. Unfortunately, I am trying to do a shortcut and trying to figure out. Yeah, I don't really have much. You have to basically blow it up. You can experiment with this on your own and see how you get there. I think you right click on the ticker, and under trading tools, you'll see an option for Book Trader. And when you open Book Trader for any market, you will see the whole distribution of trades, orders. You see the whole distribution of order, and this thing is called an order book. Okay, this thing is called an order book where you see all the orders for a particular market. All right, so you can see this for any market. So the first thing you have to understand is the order book, the full order book. What you're looking at here is pretty much the full order book. What you're looking at here is pretty much the full order book. Okay. And this is one option that we have to look at. One thing we have to look at, the order book. So you understand this order book. So this basically, what is the order book basically is, okay. So what you're seeing normally, when you look at a normal TWS classic display, okay, what you are seeing is only the top of the book. Okay, this is called the top of the book. You'll see the best offer. Okay. You'll see the best offer and you'll see the best bid. Okay, so the best bid obviously is the highest bid because the bid is the price at which the seller will sell. Okay, the price taker will sell. These concepts, you have to be clear about these concepts. These are covered in this note, trading on quotes. Okay, you should cover and recap your concepts here. Okay, I'm not going to have time to go into all this. Should be 100% clear about all these concepts: market makers, price takers, price makers, price takers, trading on bids and offers. Okay, so when I'm selling, you should already got a feel of it from your trading. Okay, so here what you can see, I can't really show you much, but I'll try to make it as big as possible. Okay, so here's what you see. All right, so this is where the market is, and these are the offers, and these are the bids. Okay, so now these are all the bids. So this is a full order book. Let's assume it's a full order book display. And so all the orders are called the full order book when you see all the orders. And so this is basically the full market depth. There's another term that we use called market depth. Okay, it's there in your notes. So there's the market. You're able to see the full depth of the market. Essentially, you're able to see the full order book. Now, there's something else here, which is another term you need to know, which is the top of the book. Okay, this is called the top of the book. Normally, when you see, when you look at your classic TWS or even in your Mosaic, when you look at the bid offer display, okay, when you see this normal bid offer display for any market, okay, you will see that it's basically just referring to the best offer. It's just showing you the best offer, which obviously is the lowest offer, because offer is the price at which, as a price taker, I will be buying, and bid is the price at which, as a price taker, I will be selling. So the best offer is the lowest offer, and the best bid is the highest bid. Okay, so there is a concept of, in most countries, they have many exchanges, like in India as well, we have many exchanges, in the US also. there's this concept of a national best bid and offer, NBBO. I think I've used that term here. I can use this term here, NBBO, which should be remembered as National Best Bid and Offer. Okay, National Best Bid Offer. All right. So this is the term that this is a term that is used in the US. Okay, but the concept can be applied in any country. So essentially, what they show you in any trading system is the best bid and offer in the main display, because they can't show you all this information for every stock. So because all these rows are occupied with other stocks or other tickers. So what you have here is this whole thing. This is the full order book or the full market depth. Okay. And the other term you need to know is the best bid and offer at any point of time is essentially called the top of the book. Okay. This is the other term that we use, top of the book. So these are some of the terms that you should know, because when you're talking about order types, these ideas are all connected. Order types, you should make sure you have some understanding of the technology architecture of trading. Okay, it requires you to understand exchange traded markets and OTC markets. But understand that at least there are three players: customer, broker, and exchange. Okay, so this is the exchange traded. This is the ETM framework. If you understand ETM is more complex. If you understand ETM, then you can understand OTC much easier to understand. Try to focus on ETM, understanding this concept, then understanding order books. Okay, these are all important terms in trading. Order books, and whether you're doing risk management for a corporate treasury, also you'll have to be very, very familiar with financial markets and how they work. So you need to understand all these concepts. So best bid and offer, top of the book, order books, full market depth. Okay. Yeah, so as I said here, OTC is much simpler. These are all, so yeah, so if you have anything better than top of the market, top of the book, you have some level of market depth. Okay, so if you have something like this, you have the full order book, you have the full market depth. Otherwise, we say there is some level of market depth. So when you hear these terms, this is what these terms are referring to. These are the ideas that are being referred to in these when we use these terms. Okay, so I think we are, one sec, where are we here? Okay, we are exactly at the time where we are ending the class. 1 minute, just let me see. I think so what we have done is essentially yeah, so the other thing is that you understand we are getting this information free, all the live trading information, the free prices, free live prices, because of the broker wants to support students in their learning. But understand, in the real world, exchanges try to make money by selling access to the information generated by the orders and trading. Okay, so all this price information, volume information, in general, exchanges try to make money by selling this info. Okay, so what we have done today is we have covered this, we just covered DP5. Okay, completed the coverage of DP5. We will continue then with next session. We'll continue with completion of DP 6.1. We have some things to discuss there, and then we will continue onwards to your trading project, which is going to be on options. I'll send you the tickers later on, but please follow your instructions. Please don't make any mistakes regarding your trading submission. Okay, please. Anybody has any questions about the trading submission? Okay, so your class is dismissed. Okay, and I will hopefully get my speaker system fixed by the time we have the next class. All right, so you guys can leave. And Mitali, I had asked you to ask me your question, but unfortunately, because the volume now is very bad. What is your? Let's try see if we can understand your question. Yeah. So what I would say to Mitali is that your problem that you have. Are you there, Mitali? What happened? Vipul, yeah, what do you want? Vipul, what is your question?
Yes, sir. Sir, do we have to submit the complete order file, the trade file which we have done in the month?
No. You follow have you watched the video I sent you last night?
Yes, sir. I have watched the video, sir.
No,
in which,
video
sir,
is clear. It does not ask you to submit all your trades. it is only asking you to submit a spreadsheet along with the backup PDF files.
Okay, sir.
So you have 5 weeks approximately, I think, whatever number of trading days. And every day there is a PDF file for the statement for that day. And then you have a spreadsheet where you have to enter the data from the PDF files according to the format given in the video and the notes.
Okay, sir.
Yeah, no need to submit all the trades. Trades information I can see in the PDF files for the account statements. So I can see that from there. Yeah.
Okay, sir.
What happened to Mitali?
Sir, everything is clear in the video, no, sir. We just need to follow a video only.
Correct, correct. Just follow. And also please note the session notes for today. I've given some instructions on the font size and the typeface and all that. And the deadlines, okay? Please make sure you don't lose points by submitting late. And don't send me attachments. Follow the instructions in the video. So good. So anyway, Mitali seems to be sleeping. So please convey to her because she had a question.
No, sir.
Actually, sir,
No, sir. Actually, I had some audio glitch, so I was trying to
Okay.
unmute,
Okay, never mind.
but I wasn't able.
So your problem, I would suggest that since you have not been able to solve the problem through the iPod, I suggest what you do is, you see, anyway, it will be captured in your NAV. So what happens is you can't close it, let it be. You just keep your fingers crossed that nothing else happens. I mean, not much movement happens because you only have, I think, 2 more days to trade or 1 more day to trade. Today is 14th. You have 2 more days of trading, right? 2 more days of trading. So just keep your fingers crossed. Nothing much happens, and then you just or you see the bias of your position. Now you can get an early indication of hedging. Okay. So if you see, I think what we saw is most of your positions are long positions, correct? In the iBot, all your positions are long.
Yes, sir.
Okay. So which means now you try to get a sense of how much now you can use this problem to learn about hedge risk management in advance. See, all your systems, basically what you have is you're long a bunch of stuff. Okay. You have a whole bunch of trades that you're long. Now, here's an important, let's assume that these are mainstream stocks. You have to see which ETF. Let's assume, okay, SPY is a good indicator. For your stocks. SPY is the S&P 500 index. It's an ETF which tracks this. Okay, this is one of your tickers. I mean, it's not one of your tickers in the project, but you can get this ticker on the IBTWS. So this is an indicator for the whole market. Okay, it's a broad market indicator. It's like your Nifty 50. It's a US example equivalent of the Nifty 50. So now what you have is you're long a whole bunch of stocks. So what you do is figure out the total current market value of all your iBot positions. Okay, figure out what it is. Maybe $75,000, whatever it is. Okay, so you got a long position of $75,000 roughly in the market, a whole bunch of stocks, and for some reason you're not able to sell the stock. So what you do is you're worried about the stock prices going down. So what you can do is get some practice on hedging. Advanced practice. So what you do is now SPY is an indicator of the broad market. Okay. So what you do is you can't sell those individual stocks, let's say, which are coming up to total of $75,000 in value. What you do is you sell $75,000 of SPY. So you set up SPY as a ticker and you see the current value of SPY, which is around 350 or something. Okay. So you divide $75,000 by 350. You get a number of units, okay? And of course, you have to get it in multiples of 100 to ideally trade in market lots. Then that many units, what you do is you sell SPY. You understand what I'm saying, Vitali? Are you following what I'm saying?
Sir, I have to the number of units. Which,
Okay, never
sir,
mind.
am I
To
audible?
explain in a post-class session. But what I'm saying is either you keep your fingers crossed that not much happens, but otherwise what we can do is here, let's take this. we have one of the things you have in your FDRM is this one. FDRM, I think we already have this. Yeah, this is already there. Today's session board. I don't need this. I don't need this actually. I don't need this also. Here. So today's session board, today is actually 1410. Okay, we'll take care of this later. 1014. So what happens is your I bought long positions. Okay, so I bought long position value is $75,000. Okay. Now can't sell this. Okay. So what is the SPY price? SPY price is around 355. Let's say 355. Okay. How did this get to here? Yeah. So SPY is a ETF for the whole market. Okay. So it's a broad market. Broad market index. SPY price is, say, what did we say? 350, 355. Let's say 350. Whatever the price.
355.
So the problem is you have a bunch of stocks long here which you can't sell, but you want to lock in your market risk. So what you do at the value of this stock position, you figure out what it is from by looking at your account statement, from what we did a couple of nights ago when we had the session on Zoom, where we looked at your account display under portfolio. You can see the market value of your positions. Okay, so here is your market value here. Okay, so market value of your position is this. Okay, so now per unit SPY the price is 355. So you can't sell this stuff for whatever reason. So what you want to do is you want to sell the broad market as a hedge. So what you do is you take the market value here, $75,000, and divide by 3.
Divided by 350.
Okay, so that comes to, if we take this as a two decimal thing, 211.27. So this 0.27 you'll have to forget about. So you have to take this. You have to take integer of this, which is 211. Okay. So what you do now is you want to sell 211 units of SPY. So at the current levels, it's a very crude hedge because as the market moves, the other stocks position will also move. You'll have to keep on adjusting your hedge, but you have only 2 days left, so you don't need to worry. Maybe not too much adjustment required. So what you have done is essentially by selling 211 units of this is what 211 point 1 minute per unit, 211 shares of SPY is 75,000. Okay. If you divide by this is 211. So that means actually you will have to now further divide this by 100. So essentially you will only sell 2 units of 2 lots of SPY because that's 200 shares. Okay. So
Okay, sir.
that's how you will sell. Okay. You have to further divide this by 100. Okay. So this should be actually integer of this divided by 100. This is basically 2. So you will sell 2 lots of SPY, okay, and that will be a short position worth around $75,000. So you have hedged yourself in case your iBot stocks drop in value. The loss on the iBot shares is offset by the gain on the short SPY position. You have some idea about what I'm saying here?
Yes, sir. Sir, only the last part, why we have divided by 100 again.
Because 100 is the market lot.
Okay, sir. Got it. Yes, sir.
Yeah, so that's the idea. So this is the advanced introduction. Because of your problem, we have an advanced introduction to hedging. This is actually
Okay,
coming
sir.
up only in IFM in your next semester. But you have an advanced introduction to hedging because of your problem. Okay, so you just
Yes,
keep
sir.
your fingers crossed. You can try this trick if you want to, and you have only a couple of days more of trading. Okay.
Okay, sir.
All
Thank you, sir.
all right. Anybody else has any question? I would suggest if we can keep the question for the next session, it'll be better unless you have something important. Obviously, then you ask it. The reason I'm saying that is because my audio is not working very well. It's a little hard for me to hear you. But obviously, if you have something important, please ask it now itself, which can't wait for the next class. Anybody, anything? Okay. All right. Okay, guys, thanks. So we'll end the class here. And but of course, if you have any important question, you can always ask. We have a couple of chat messages. Let's make sure what. Let's look at what it is. Okay, fine, no problem. Yeah. So Krish has also asked a question about selling the stocks. You don't have to sell it. Ideally, you would practice selling it. Okay, if you're closing your positions, you should get that practice. But even if you don't close it, the NAV is going to capture your unrealized PNL as well. So it's more important to just follow the instructions. I would suggest another thing I would suggest is please start doing your statement generation from now itself. So you save your time and don't get delayed. Okay. All right. So we'll stop this recording.